Welcome to the research desk. I want you to imagine just for a second that you're sitting in a really crowded theater.
Okay, I'm picturing it.
The production on stage is absolutely fantastic. I mean, the ticket prices were the cheapest in history. The seats are incredibly comfortable. Everyone is just, really enjoying the show.
Sounds like a great night out.
Right, it's perfect. But suddenly, somebody in the back row yells, "Fire!"
Oh, boy.
Yeah. So you jump out of your seat, you run for the exit, only to realize that the massive double doors you walked through, they have mathematically shrunk down to the size of a keyhole at the exact moment the crowd needs to leave.
That's a pretty terrifying image.
It is. And today we are asking a pretty profound question. Is the architecture of the modern global financial market exactly like that theater? We're doing a really deep dive today, a comprehensive analysis of high-frequency trading and algorithmic market structures.
Yeah, the basic plumbing of global finance, essentially.
Exactly. The central question before us is this. Is high-frequency trading the essential, highly efficient guardian of modern market liquidity? Or is it, as some argue, a sophisticated predator that just provides an illusion of depth while actually amplifying the systemic fragility it claims to cure?
Well, I'm glad you framed it that way because my position is firmly the latter. High-frequency trading acts as a sophisticated predator.
I figured you'd say that.
Look, it provides entirely illusory liquidity. Sure, the system looks highly efficient under calm, sunny day conditions, I'll give you that. But it creates this severe structural dependency and a really terrifying endogenous instability.
And you think it just breaks down under pressure?
I know it does. This algorithmic liquidity vanishes at the exact microsecond it is needed most. It transforms routine market stress into catastrophic systemic failure. We have essentially optimized our entire financial architecture strictly for throughput during periods of calm,
Right.
leaving it dangerously, and I mean catastrophically fragile under load.
Well, you know my position. I argue that high-frequency trading serves as essential, truly irreplaceable market infrastructure.
Irreplaceable. Come on.
Yes, irreplaceable. Over the past 3 decades, it has systematically democratized market access. It shattered those antiquated, frankly extractive monopolies on the trading floor, and it drove unprecedented efficiency.
Efficiency for who, though?
For everyone! It provides continuous liquidity provision at highly competitive spreads, and that results in monumental, compounding cost savings for every class of market participant, from the largest sovereign wealth fund down to, the individual retail investor just managing their retirement account.
I think you're looking at the best case scenario and ignoring the structural rot.
Well, before we start fighting over the implications, we really need to establish the sheer scale of the transformation here, because the markets operating today are just fundamentally unrecognizable from those of 30 years ago.
Oh, completely unrecognizable. Or even 20 years ago, really.
Right, we are looking at an environment where algorithmic and high-frequency trading, they now account for more than 50% of all U.S. equity volume.
Yeah, over half the market is just machines talking to machines.
Exactly. This is not some marginal fringe activity operating on the periphery. This is the dominant paradigm of price discovery and trade execution, period.
And the most striking metric of that shift, at least to me, is the dramatic plummet in the average trade size.
Oh, the trade size data is wild.
It really is. Like, if you go back to the early 2000s, the average trade size executing on the tape was roughly, 1,500 shares?
Yeah, right around there, 1,500.
And by the mid-2020s, that figure completely collapsed. It's around 200 shares now.
So we've moved from a market of discrete, large block transactions negotiated over the phone by actual human beings to a market of microscopic, continuous interactions executed by machines.
Exactly. Institutions just don't execute a single block of 50,000 shares anymore.
No, they'd get front-run to death if they tried.
Right. So they utilize execution algorithms to mathematically slice that huge order into thousands of tiny child orders.
Yep.
And they feed them into the market across multiple venues, millisecond by millisecond, over the whole day just to camouflage their intentions and minimize their market impact.
Which makes sense. But look, that fragmentation of order flow into those thousands of microscopic child orders, it's a critical piece of the new reality.
It is, but you really can't evaluate it in a vacuum. If we are actually going to understand how this machinery behaves under pressure, we have to look at the coevolution of the passive investing layer.
You mean the index funds?
Yes. Passive investment vehicles, primarily index funds and ETFs, they now control roughly 50% of total U.S. equity fund assets.
Which is a massive chunk of the market.
It's unbelievable. So just think about the magnitude of what we are dealing with here. We have two massive automated forces completely dominating the landscape.
Right, the high-frequency trading handling the microsecond execution.
Exactly. And passive investing dictating the broad capital allocation at the macro level.
So they feed into each other.
Oh, absolutely. And this brings us directly to that foundational research by Sullivan and Xiong from 2012.
Ah, yes, the mechanical concentration paper. Right, their work demonstrated precisely how the rapid rise of index trading fundamentally increases market vulnerability. Because when capital flows are directed by passive mandates, those flows become mechanically concentrated.
Wait, let me make sure I'm picturing this correctly for the listener, just to be clear. When you say the capital flows are blind and mechanically concentrated, you are referring to the fact that an index fund doesn't care about the earnings report of a specific company, right?
Exactly.
It just buys everything in the basket simultaneously.
Yes. If an everyday investor allocates $1,000 to an S&P 500 index fund, that capital is deployed across 500 constituent companies strictly according to their market cap weightings.
No human analysis involved? None. It happens entirely regardless of the underlying asset fundamentals, the debt load, the quarterly earnings. None of it matters. And Sullivan and Xiong showed that this mechanical allocation systematically strips away idiosyncratic price discovery.
Because the companies aren't being judged on their individual merits anymore.
Exactly. In a traditional market, if Company A has a terrible product launch and Company B has a huge technological breakthrough, capital should naturally flow out of A and into B.
Right, they operate independently.
But the passive layer correlates the liquidity of hundreds of distinct securities. When macro money flows in, it flows into everything simultaneously.
And when money flows out?
When it flows out, say due to an inflation scare or a geopolitical event, it flows out of everything simultaneously. The entire market basically becomes one giant correlated asset.
Okay, I accept the premise of Sullivan and Xiong's findings regarding the correlation of macro capital flows. I mean, that is just an undeniable reality of the shift toward indexing.
I'm glad we agree on that.
But we must separate the mechanics of passive asset allocation from the mechanics of high-frequency trade execution.
I don't see how you can separate them when they share the same pipes.
Look, acknowledging this mechanical, hyper-fast, highly correlated reality is necessary. But the interpretation of its impact on the end investor is exactly where our divergence begins today.
All right, let's hear it.
I submit that high-frequency trading, functioning within this massive, complex scale, actually acts as a vital public good.
A public good? Wow.
Yes, through the direct, measurable mechanism of cost reduction. The empirical data is simply unequivocal on this point. Let's look at bid-ask spreads.
Okay, let's look at them.
For the audience, the bid-ask spread is just the difference between what a buyer is willing to pay and what a seller is willing to accept. It is the core cost of trading.
The toll booth.
Right. In the early 2000s, that spread on a typical large-cap equity was roughly 6 cents per share.
Yep.
By the 2020s, high-frequency algorithms had compressed that spread to less than 1 cent.
Mostly?
That spread compression represents a direct, massive, and permanent cost reduction for every single investor participating in the global economy.
I come at it from a totally different way.
How so? The math is the math. 6 cents down to less than 1 cent.
We look at that exact same spread compression from 6 cents to a fraction of a cent. But I fundamentally question whether this hyper-efficiency in pricing is truly a public good.
How could saving people money not be a public good?
Because it might merely be an extractive mechanism that only looks like efficiency on a perfectly calm, sunny day.
Oh, the sunny day argument again.
Hear me out. You calculate the aggregate savings based on those tight spreads, which makes for a really great headline number.
It does.
But those microscopically tight spreads are entirely contingent on a benign macroeconomic environment. If the algorithmic liquidity provider decides to step away during a moment of volatility, which, by the way, they are explicitly programmed to do.
They manage risk.
Right. They step away, and the actual cost of execution for an institutional investor seeking to exit a position skyrockets instantly.
But
let me just finish this thought. The massive spread widening that occurs during a crisis instantly erases the incremental pennies saved during a month of calm trading. We have essentially traded robust, reliable liquidity for cheap, highly conditional liquidity.
See, I am just not convinced by that line of reasoning because it completely ignores the historical baseline.
The historical baseline was fine.
No, it wasn't. We cannot evaluate the current algorithmic system against some utopian ideal of perfect liquidity. We have to evaluate it against the very real, very flawed system that it replaced.
You're talking about the floor traders.
Let's consider the historical transformation of the Nasdaq market. If you were trading in the late 1990s, the Nasdaq operated as a dealer-dominated market.
Yes, it did.
The market makers, acting as the designated specialists, they maintained a rigid, highly protective oligopoly. They systematically kept spreads artificially wide.
They were compensated for providing a service.
They were overcompensated. They often refused to quote prices in anything less than increments of an eighth or a quarter of a dollar.
That was just the structure of the time.
It was an extractive structure. If a stock's true clearing price was $10.12, they would force you to buy it at 10 1/4 and sell it at 10 1/8.
Right.
That artificially wide spread was pure profit for the dealer. This was not robust, reliable liquidity. This was a protected cartel extracting a massive, continuous toll from the investing public.
And you are seriously suggesting the algorithms are inherently more noble?
Noble? No. I am suggesting they are vastly more competitive, which forces a much better outcome for the public. Electronic trading shattered that specialist monopoly.
It just replaced human monopolists with machine oligopolies.
It decentralized power away from a privileged sort of golf club group of specialists on a physical trading floor, and it moved it into a transparent, electronic, order-driven system.
Transparent is a strong word for dark pools, but okay.
Spreads narrowed dramatically, not because of a temporary period of calm, but because the artificial, structural barriers to competition were permanently demolished.
Okay, but
Retail execution improved structurally and permanently. High-frequency trading firms now provide continuous liquidity provision at highly competitive spreads simply because if they don't, another algorithm will beat them to the trade by a single microsecond.
sure.
They replaced outdated human intermediaries who operated with far less efficiency and significantly more self-interest.
That is a very compelling narrative of democratization. I'll give you that. But let's look closer at what those modern market makers are actually doing.
Before we do, I want to add one more piece of theoretical backing regarding the stabilizing nature of these modern algorithms.
All right, let's hear the theory.
We have to look at the work of Brown from 1999. He modeled the behavior of what he called noise traders.
Oh, right, the sentiment traders.
Exactly. A noise trader is a market participant who acts on emotion or sentiment or momentum, rather than fundamental informational analysis.
Retail traders panicking, basically.
Mostly, yeah. Brown demonstrated how these noise traders actually cause systematic risk by driving asset prices far away from their fundamental intrinsic value.
Okay,
No, high-frequency trading firms, operating completely without human emotion, they ruthlessly trade against that short-term noise
by picking them off.
by fading these sentiment-driven mispricings, selling when the noise traders are irrationally buying, and buying when they are irrationally selling.
So they're the ultimate contrarians.
Mechanically, yes. And by doing that, they actually dampen rather than amplify market volatility. They incorporate new, fundamental information into prices within milliseconds.
I see where you're going with this.
Because of this rapid price discovery, institutional investors who are executing those multi-day block trades actually face a vastly lower average market impact today than they did during the specialist era.
Okay, that entire argument relies totally on the assumption that the liquidity provided by high-frequency trading firms is functionally equivalent to the liquidity provided by traditional market makers, just executed faster and cheaper.
Because it is.
But the academic literature demonstrates conclusively that this is fundamentally untrue.
I completely disagree.
The primary problem, and really the core of my structural concern today, is the pervasive phenomenon of phantom liquidity.
Oh, phantom liquidity?
Yes, Maureen O'Hara, in her seminal 2014 research, articulated beautifully how high-frequency trading fundamentally changed the very mechanics of how markets operate.
She did write a great paper.
I'll admit.
She proved that we have created a perilous systemic dependence on machine-provided bids and offers that are not firm commitments to trade.
They're dynamic.
They are merely fleeting signals.
Let's break that down for the listener, though. What exactly is a fleeting signal in the context of the order book?
Sure. Imagine you are looking at the order book for a major stock on your trading screen.
Okay.
You see that there are bids, people willing to buy, for 10,000 shares at a price of $50. It looks incredibly deep and robust.
Lots of buyers.
Right. You think, great, there is plenty of liquidity. I can easily sell my 5,000 shares right now without moving the price.
Makes sense.
But that depth is an absolute illusion. It is phantom liquidity. These orders can be, and routinely are, mathematically canceled in fractions of a microsecond.
Because the market changes.
No, because when an institutional investor actually submits a firm order to interact with that liquidity, the high-frequency algorithms detect the incoming order.
They can't see the future.
They don't need to. Often, the algorithm is simply faster than the exchange's own matching engine, so they instantly cancel their quotes before the trade can even execute.
That's a bold claim.
It's documented. They flash a massive buy order to the market to create the illusion of demand, drawing other participants in, and then they completely vanish the moment someone tries to hit that bid.
Look, I see why you think that, but let me give you a totally different perspective on the mechanics of order cancellation.
I'm eager to hear how vanishing bids are good for the market.
The cancellation of orders is not inherently nefarious. It is an absolutely necessary component of risk management for a market maker quoting thousands of securities simultaneously.
Risk management for them, maybe, not for the rest of us.
Think about it. If an algorithmic market maker is providing bids and offers on 5,000 different stocks, they are exposing themselves to immense directional risk.
Right, because they hold inventory.
Exactly. When macro news hits the wire, say an unexpected interest rate hike from the Fed, the true fundamental value of all those stocks changes instantly.
Sure.
The algorithm must be able to cancel its stale quotes in microseconds to reprice those assets.
Steel quotes, right.
If they could not cancel those orders, they would be immediately picked off by informed traders acting on the new information. They would literally be adversely selected into bankruptcy within a week.
Crimea River.
I'm serious. If you ban rapid cancellations, you essentially ban modern market making, and spreads will instantly revert to those medieval fractions we saw in the 1990s.
Well, I don't buy that it is simply prudent risk management. It is a highly calibrated mechanism of extraction.
Extraction how?
This brings us to the core technical issue, latency arbitrage.
Latency arbitrage. The boogeyman.
High-frequency trading profits immensely by exploiting microsecond speed advantages that have absolutely nothing to do with fundamental asset valuation. Let's actually trace how this works in the real world.
Go ahead.
These firms invest hundreds of millions of dollars in proprietary microwave towers and dedicated fiber optic networks.
The infrastructure is incredible. Yes.
Why do they do it? To transmit market data between the futures exchange in Chicago and the equity servers located in Moa, New Jersey.
Right, the Mawa data center.
Because light travels through the air via microwaves faster than it travels to the glass of a fiber optic cable.
It's physics.
Feeds, the standard feeds that retail brokers and mutual funds use, can process that exact same information.
But how does that microsecond advantage actually translate into the extraction you are claiming? Who gets hurt?
Here's who gets hurt. When a price discrepancy occurs between two different exchanges, say an ETF ticks up slightly in Chicago, indicating a coming rise in the underlying stocks in New York, the high-frequency algorithms arbitrage that difference before slower participants even know the event has occurred.
They bring the markets into line.
They buy the underlying stock in New York and instantly sell it higher, completely risk-free. This is effectively a hidden structural tax on every other market participant.
A tax.
Yes. Slower participants, which includes massive pension funds representing millions of everyday retirees, they are constantly trading at inferior prices because the high-frequency firms have already picked off the best available quotes.
I have to severely challenge the framing of latency arbitrage as a hidden tax.
How is it not?
Latency arbitrage ensures perfect price consistency across highly fragmented global markets.
Perfect consistency for a fee.
Let's use your example. If an exchange-traded fund is trading at $100 in New York, but the aggregate value of its underlying basket of stocks is currently pricing at $99.90 in Chicago, that 10-cent discrepancy is a market failure.
It's a momentary lag.
It represents a pricing inefficiency. High-frequency trading closes that gap in microseconds, ensuring that retail investors are never buying an ETF at a premium to its net asset value. They strictly enforce the law of one price.
Okay, closing the gap is theoretically fine. I'll admit that price alignment is useful, but they are doing it by stepping entirely ahead of the institutional buyer who actually wants to hold the asset for the next 5 years.
They're providing the liquidity.
No, they are extracting a micro rent on every transaction. And furthermore, this entire ecosystem thrives on intentional fragmentation.
Intentional?
Yes, order flow in the modern era is split across dozens of different execution venues. We have 13 public exchanges in the United States alone, plus over 30 dark pools.
Right.
And massive internalizers who execute retail flow off exchange entirely. Because the order flow is so deeply fragmented, true aggregate market depth is completely impossible to measure.
It's definitely harder to measure.
It's impossible. You cannot possibly know the actual supply and demand for a given security because the algorithmic quotes are duplicated across multiple venues and can, as we just discussed, vanish instantly.
So if you're listening to this right now and checking your Vanguard portfolio, you might be thinking, look, my index funds are doing fine. The market goes up over time. Why should I care about microsecond latency or dark pools?
You should care because this highly fragmented, hyper-fast architecture creates profound endogenous instability.
Explain endogenous instability.
The risks to your portfolio are no longer just exogenous shocks to the real economy.
Like a global pandemic or a banking collapse?
Exactly. The risks are now manufactured from inside the system itself. Mechanical feedback loops, automated stop-loss cascades, model-driven imitation algorithms, they interact with each other in ways that literally no human programmer can accurately predict.
The machines talking to each other?
Chordia, Wool, and Subramaniam demonstrated this mathematically way back in their year 2000 research. They empirically show that bid-ask spreads co-move across stocks. Liquidity itself is highly correlated.
Meaning that when one stock becomes hard to trade, they all become hard to trade?
Precisely. This means that when algorithmic liquidity dries up, it doesn't just dry up for a single troubled company that missed its earnings target.
Right.
It dries up everywhere, across the entire market, simultaneously. The algorithms apply a global risk-off parameter.
Which makes sense from a risk perspective.
Crutley and McCabe in 2020, regarding that massive shift to passive investing we discussed earlier, the danger compounds exponentially.
Because the passive funds move as a herd?
The passive shift creates mechanical herding behavior, yes. It severely degrades the idiosyncratic price discovery of individual assets, and it ensures highly correlated outflows during periods of stress. The entire modern architecture is literally rigged for a correlated system-wide collapse of liquidity.
Look, I see why you think that, but let me give you a different perspective.
I'm listening.
Theoretical models of endogenous instability and correlated liquidity co-movement. They are intellectually fascinating for academic papers.
They are mathematically sound.
But you must prove that these vulnerabilities manifest as actual sustained systemic failures in the real world, rather than just brief, self-correcting mechanical blips.
Brief blips.
Market structure is constantly, rigorously tested by exogenous shocks. We have had sovereign debt downgrades, unexpected election results, global pandemics,
And flash crashes.
but through all of it, the system consistently processes massive volumes of complex information, instantly reprices global assets, and continues to function without collapsing. The correlations you mentioned certainly exist, but the algorithms are specifically designed to aggressively find the new clearing price and restore equilibrium rapidly.
I'm sorry, but I just don't buy that.
You don't think it restores equilibrium?
Let me tell you why. You ask for proof of systemic failure in the real world. We don't have to rely on theoretical models. We must meticulously examine the events of May 6, 2010.
The flash crash.
The flash crash. This was not a theoretical exercise in a university laboratory. This was the terrifying, real-world manifestation of phantom liquidity and endogenous instability.
It was an anomaly.
Let me walk you through exactly how the system broke down. At exactly 2:32 p.m. Eastern Time, a single-cell algorithm, later attributed to a large institutional order executing in the E-mini S&P 500 futures market in Chicago, began to sell aggressively. They were trying to hedge a large equity position.
And just to clarify, this was a human institution pushing the button to execute a traditional hedge, correct? Not an HFT firm going rogue.
Yes, a fundamental investor attempting to execute a large trade. Now, in a traditional human-dominated market, the market makers on the floor would have absorbed that heavy initial flow.
Right.
They would have widened their spreads to compensate for the risk, manage their inventory, and gradually smooth the price impact over hours.
That's the ideal scenario, sure.
But instead, the high-frequency algorithms acting as market makers instantly detected the sudden order imbalance and the resulting microsecond volatility.
Because the volume was massive.
Their internal risk parameters, which are explicitly programmed to avoid massive directional exposure, were immediately breached. So what did they do?
They pulled back.
They systematically and simultaneously canceled their bids and completely withdrew from the market. They effectively shut off their machines. The withdrawal of liquidity was cascading and instantaneous.
The order book just emptied out.
Completely. Without the algorithms there to catch the falling knife, the massive sell order began matching with whatever bids were left, plunging deeper and deeper into the order book.
It was a very steep drop.
The sheer violence of the crash was historically unprecedented. The Dow Jones Industrial Average plunged nearly 1,000 points in a matter of minutes.
It was shocking to watch.
The contagion spread immediately from the futures market in Chicago straight into the equities market in New York. How? Via those latency arbitrage algorithms we talked about.
Right. They linked the markets.
Procter & Gamble, a massive blue-chip company with a foundational market capitalization, dropped nearly 37% almost instantly.
Wow.
Accenture, a massive global consulting firm with billions in revenue, traded at exactly 1 cent per share. 1 penny.
For a fraction of a second.
It doesn't matter. It was the market equivalent of discovering that the fire department had completely left the building before the fire alarm even went off. The very entities that claimed to provide robust, continuous liquidity evaporated at the exact moment the market actually needed them to absorb the shock.
But
let me finish this. Ultimately, the exchanges had to step in and manually cancel over 20,000 completed trades across more than 300 individual securities simply because the algorithmic prices were completely divorced from economic reality.
Okay, the events of May 6, 2010 were certainly severe. Nobody denies the terrifying visual of the Dow plunging 1,000 points in minutes.
Terrifying is an understatement.
But your interpretation completely ignores the conclusion of that exact same event. The flash crash proved that immense efficiency and momentary fragility can indeed coexist, but it also unequivocally proved the ultimate mechanical resilience of the algorithmic system.
Resilience? Are you joking?
The market did bounce back. The Dow Jones recovered the vast majority of those 1,000-point losses within minutes of the plunge.
Because they turned the machines back on.
Procter & Gamble bounced back to its fundamental valuation. Accenture did not stay at a penny.
It shouldn't have been at a penny to begin with.
Why did it bounce back? Because the algorithmic ecosystem eventually recognized that the prices had completely detached from fundamental mathematical value. Different longer-term arbitrage algorithms stepped back in to buy massively discounted assets, and they instantly restored the equilibrium.
Oh, please.
The system self-corrected at machine speed. The manual cancellation of those 20,000 trades was simply an administrative remediation for an unprecedented anomaly. It was not a signal of a permanent architectural failure. It was a stress test that the system ultimately survived.
A system that requires post hoc, manual trade cancellations across thousands of executions is fundamentally broken.
It was 10 years ago.
Relying on an administrative rollback because the machines literally drove the price of a multi-billion-dollar, highly profitable corporation to a single penny is not resilience. It is an admission of profound systemic failure.
They fixed the circuit breakers after that.
If the algorithms had not been reset by human intervention, the panic would have triggered a global margin call. But look, if you want to look at a system failing without bouncing back in 5 minutes, we must move the argument from the equity markets to the supposedly impenetrable conservative fortress of sovereign debt.
Oh, you want to talk about bonds now?
We must look at the United Kingdom gilt crisis of September 2022.
That is a fundamentally different asset class with vastly different participants.
Exactly, which is why it is so incredibly illustrative. Sovereign bond markets are historically considered the deepest, most liquid, and most boringly stable markets on the planet.
Usually.
Yes, they are the bedrock collateral of the entire global financial system. But when the Truss government announced a sweeping program of unfunded tax cuts, gilt yields spiked violently as the market processed the inflation implications.
Policy shock.
Right. Human bond traders would have heavily repriced the debt, but they would have maintained a market. They always have. But the algorithmic market makers, who now completely dominate sovereign debt execution, they simply pulled back.
Because the models couldn't price it.
Their statistical models could not process the rapid, historic yield expansion. It was a standard deviation move completely outside their programming parameters, so they simply ceased providing liquidity.
They refused to catch the falling knife.
They walked away completely. The consequences were absolutely catastrophic for the passive and institutional layer of the market. Pension funds in the UK heavily utilize liability-driven investment strategies, or LDI.
Right, to match duration.
They needed cash instantly. But because the algorithmic liquidity had completely vanished from the market, these massive pension funds could not sell their gilts to raise cash without driving the price down even further into the void.
A vicious cycle.
Which then mechanically triggered even larger margin calls the next hour. It was a classic mechanical doom loop, exacerbated entirely by the absolute absence of market makers to clear the panic.
The Bank of England had to step in.
The Bank of England was ultimately forced to intervene with emergency multi-billion-pound gilt purchases just to physically prevent a full collapse of the British pension system.
I know.
High-frequency liquidity is a ghost highway.
A ghost highway?
Think about how a modern highway works. It's built for maximum throughput, moving cars at 80 miles an hour efficiently.
Right.
But the algorithmic liquidity isn't just the cars on the road. The liquidity is the asphalt itself. It looks like a massive multi-lane highway providing incredible throughput. But the moment there is a wreck and you desperately need an exit, the actual asphalt evaporates instantly and you are trapped in a freefall.
Well, that's an interesting point, though. I would frame it fundamentally differently.
Go on.
You're assigning the primary blame for the 2022 gilt crisis entirely to the algorithmic execution layer, when the root cause was undeniably a fundamental exogenous policy shock caused by human politicians.
Politicians cause shocks. The market's job is to absorb them.
But extreme, historically unexpected government policy shifts, like a prime minister announcing massive unfunded liabilities completely out of nowhere, fundamentally alter the mathematical risk premium of sovereign debt.
Yes, they do.
In that specific scenario, human market makers on a bank desk would have withdrawn their capital just as quickly.
I disagree.
A human trader at a major global bank is absolutely not going to step in and buy billions of pounds of collapsing bonds when the fiscal policy of a G7 nation becomes highly unpredictable and, frankly, irrational.
They might widen spreads, but they wouldn't vanish entirely.
The algorithms merely reacted mathematically and rationally to an entirely irrational, human-created policy environment. They protected their capital, which is precisely what any prudent, legally bound fiduciary would do.
But the human trader in the old system possessed a formal obligation, a structural, regulated role within the ecosystem that the algorithm lacks entirely.
You mean the affirmative obligation to quote?
We really need to synthesize the analogies we are discussing to truly understand the depth of this structural flaw.
Okay.
If we look at the modern market as an immune system in normal, everyday times, high-frequency trading provides a robust defense and extremely high efficiency.
True.
It processes millions of data points, clears out microscopic inefficiencies, and keeps the financial organism running smoothly.
Right.
But under extreme stress, it triggers a devastating autoimmune attack on the system itself.
An autoimmune attack?
The algorithms do not just retreat passively. They actively participate in the downward spiral by initiating automated stop-loss orders in short selling into the very vacuum they just created.
That's a strong claim.
Or consider the theater audience analogy you opened with. The market looks entirely comfortable, highly functional, perfectly seated. Everyone is enjoying the continuous performance of tight spreads and low execution costs.
Because they are objectively good things.
But the moment someone yells fire, an exogenous shock like the UK policy change or a severe macroeconomic data miss, the audience realizes that the exits have been structurally narrowed by the algorithms withdrawing.
The liquidity dries up.
The throughput capacity of the exit is vastly insufficient for the panicked crowd. This lack of obligation is the ultimate wildcard in our entire modern financial architecture.
The lack of obligation?
We have rebuilt global finance from the ground up, around the fundamental baked-in assumption that algorithmic liquidity will always be present.
Well, we price risk that way.
Exactly. We price our institutional risk models, we price our complex derivatives, we set our collateral margin requirements based entirely on the assumption that a high-frequency counterparty will mathematically be there to take the other side of the trade in 1 millisecond.
Right.
The old specialist system on the floor of the stock exchange was objectively slower. I concede that. It was undeniably objectively more expensive.
Vastly more expensive.
But it possessed a crucial structural safeguard that we completely abandon: an affirmative obligation to maintain orderly markets.
They had to step up.
The specialists were legally required by the exchange to, quote, two-sided markets, to offer both a bid and an ask, even during periods of extreme volatility. They had to stand in the fire.
Yes, they did.
High-frequency trading firms have zero regulatory or structural obligation to stay in the room when volatility strikes. They are unregulated in their specific liquidity provision. When the mathematical risk models dictate that the environment is too dangerous, they simply unplug the machine. There is no structural fallback mechanism.
I acknowledge the vital distinction regarding the affirmative regulatory obligation to maintain orderly markets. The transition from mandated localized specialists to voluntary globally distributed algorithmic liquidity providers is unequivocally the central architectural shift of our time.
It changed everything.
What this intensive discussion really points toward is a crucial, necessary synthesis of our two perspectives.
Okay, let's synthesize.
What the general public, and honestly even many portfolio managers assume, is that high-frequency trading simply made markets better across the board.
Which is a dangerous assumption.
The reality, as we are rigorously establishing here, is vastly more nuanced. High-frequency trading made normal, everyday markets vastly better, remarkably efficient, and incredibly cheap to navigate.
Agreed.
But it made abnormal crisis markets significantly worse.
Yes.
The algorithmic machine is optimized strictly for throughput. It functions flawlessly under expected statistical parameters, making it catastrophically, terrifyingly fragile under unexpected load.
Exactly. That is the aha moment of this entire systemic analysis. The system is incredibly efficient on average, but violently fragile at the statistical extremes.
The tail risks.
And because of the massive passive investing layer we discussed earlier, those extremes are mathematically becoming more severe.
Because of the correlation.
Right. When 50% of all equity assets follow indexes mechanically, independent price discovery severely degrades. The market effectively becomes a monolithic machine that can jam catastrophically when correlated institutional flows demand immediate massive liquidity from an execution system that has mathematically decided to shut down.
Given this stark reality, the practical question is not how we turn back the clock to the 1990s, because we simply cannot. The daily aggregate cost savings are far too valuable to the global economy to abandon.
We can't put the genie back in the bottle.
Right. The question is rather how must market participants fundamentally adapt their behavior to survive this new architecture?
We need practical mitigations.
We must collaboratively detail the required operational shifts to mitigate this systemic, structural fragility. The first and perhaps most critical actionable synthesis is that institutional risk models across Wall Street must be entirely rewritten.
Completely overhauled.
Traditional risk models must rigidly mathematically separate normal time liquidity assumptions from crisis liquidity realities. You simply cannot assume that the volume and depth you see on the order book on a quiet Tuesday in July will be available during a macroeconomic shock in October.
I agree completely with the necessity of that operational shift, but we really have to go further than just updating the baseline assumptions.
How so?
If an institution is calculating its value at risk or assessing the realistic liquidation timeline of a multi-billion-dollar portfolio, using average daily volume metrics derived from high-frequency algorithms is mathematically dangerous.
It's misleading.
It is pure fiction. If algorithmic withdrawal is a given during a crisis, systems must rigidly stress test for total, absolute high-frequency trading withdrawal.
A zero liquidity environment.
Institutions must physically build internal models that assume algorithmic market makers completely disappear when the VIX, the volatility index, which measures the 30-day implied volatility of the S&P 500 based on options prices, when that spikes above an extreme threshold, say 35.
That's a high threshold.
If a pension fund's portfolio cannot survive a modeled scenario where available market liquidity drops by 80% instantly, that fund is structurally insolvent in a real crisis.
Okay, but if we assume total algorithm withdrawal is a given during a crisis, what happens to the alternative execution venues? Firms must aggressively adapt their execution strategies, specifically regarding off-exchange trading.
You mean the dark pools?
Exactly. For years, institutions have utilized dark pools to execute large blocks of stock without showing their hand to the public market.
It prevents front-running.
But in this new reality, firms must drastically limit their reliance on dark pools during periods of high volatility. Here's why. Dark pools do not discover prices themselves.
Right. They peg to the public exchanges.
They rely entirely on the public reference price, the National Best Bid and Offer, or NBBO, generated by the public exchanges.
And when the algorithms withdraw from the public exchange,
During a flash crash or extreme algorithmic withdrawal, that public reference price completely degrades. It becomes highly erratic as quotes vanish.
it's flying blind.
Attempting to execute a massive block of shares in the dark when the illuminated public market is faltering leads to severe, unpredictable execution anomalies.
That is absolutely correct. The dark pools become entirely blind when the public exchanges fail.
And this mitigation logic directly addresses the passive indexing layer we debated. We need strict, systemic concentration monitoring.
Monitoring the index funds?
This is crucial for anyone managing broad risk. When passive, mechanical index ownership exceeds 55% of a given market sector, active institutions must radically increase their hedging against that specific sector.
Because the fundamentals disappear. Exactly. At that extreme level of mechanical ownership, the idiosyncratic fundamentals of the underlying companies, their debt, their cash flow, are entirely subsumed by the massive macro flows of the index.
It just moves as a block.
If a sector is entirely owned by passive funds, a single unrelated macroeconomic shock will trigger simultaneous mechanical selling by the algorithms, resulting in a localized flash crash. Portfolio hedging strategies absolutely must account for this correlated flow risk, not just the traditional corporate risk of the asset.
To navigate that correlated flow risk, market participants must deploy highly advanced technological solutions. They must build and deploy sophisticated execution algorithms that can actively detect market fragmentation and route orders intelligently in real time.
You have to fight fire with fire.
It is no longer sufficient for a broker to use a simple legacy volume-weighted average price or VWAP algorithm to just blindly buy a stock over the course of an hour.
No, they'll get crushed.
The routing logic must mathematically understand latency. It must be programmed to anticipate the phantom liquidity you described.
It has to know which bids are fake.
And it must be able to probabilistically assess which execution venues are actually providing firm, reliable quotes versus which are just flashing fleeting signals to trigger arbitrage. If the modern market is a highly complex machine, you must use a sophisticated, adaptive machine to navigate it.
But we cannot rely purely on private institutional algorithms to police the market. There is a critical systemic importance to maintaining and rigidly enforcing governance rules at the regulatory and exchange level.
The circuit breakers.
If we broadly accept that the modern market fundamentally lacks an affirmative obligation to provide liquidity, then the exchange itself must impose hard mathematical stops.
Right. The limit up, limit down rules.
The limit up, limit down mechanisms, which are designed to mechanically halt trading in a specific stock if its price moves outside a defined percentage band within a rolling 5-minute window, and the broader market-wide circuit breakers. They are the only true structural defense against a runaway algorithmic feedback loop.
They're the emergency brake.
They act as the emergency brake. They force a physical temporal pause, allowing human participants to assess fundamental value, and critically, allowing the algorithmic models to reset their risk parameters before they drive the entire market to zero.
Finally, all of these operational shifts point to an overarching educational imperative for the entire financial industry. Deep market structure literacy is no longer a niche, specialized subfield for quantitative analysts sitting in a back office somewhere.
No, everyone needs to understand it.
Understanding the exact technological plumbing of the market is paramount. A portfolio manager must understand how the securities information processor, the central SIP feed that consolidates public quotes, actually distributes data versus a direct exchange feed.
They have to know where the data comes from.
They must understand the impact of maker-taker fee models, where exchanges literally pay algorithms rebates to provide liquidity.
Yep.
They must grasp the physics of microwave networks. This mechanical literacy is now exactly as important as understanding traditional corporate valuation, discounted cash flow models, or balance sheet analysis.
It's arguably more important during a crisis.
If you do not intimately understand the plumbing, you cannot possibly understand the true realizable value of the asset, because the asset is ultimately priced and liquidated by the plumbing.
To summarize our substantive journey today, we have unpacked a profound historical transformation in global finance.
We covered a lot of ground.
We openly acknowledge that the transition to electronic, algorithmic markets has yielded undeniable, real-world benefits: tighter bid-ask spreads, vastly faster execution times, and drastically lower average transaction costs for all participants. Those are empirical, measurable facts.
They are the backbone of modern efficiency.
But the structural hidden costs are equally real and far more dangerous to systemic stability. The risks of the 1990s have been eradicated, sure, but phantom liquidity, latency arbitrage extraction, extreme venue fragmentation, and terrifying endogenous instability have completely replaced those old risks.
We traded one set of problems for another.
We have engineered an architecture where liquidity is highly correlated across all assets, and where the massive mechanical forces of passive investing ensure that when the system inevitably breaks under load, it breaks everywhere simultaneously.
We have fundamentally established that high-frequency trading is neither a pure guardian angel of market integrity nor a purely extractive parasitic predator.
It's complicated.
It is, in reality, a highly optimized, morally neutral piece of infrastructure. It functions brilliantly within its programming, driving down friction and democratizing access during predictable calm conditions.
Sunny days.
Yet it fails spectacularly precisely when markets need it most to absorb structural macroeconomic shocks. It represents the ultimate complex trade-off between immense daily efficiency and terrifying tail risk fragility.
The market that works perfectly until it doesn't is more dangerous than the market that never pretended to be perfect.
This is the research desk officially signing off.